Namaste students, welcome back to your business studies, Chapter-02 Financial Management. In this chapter, we will be studying about the meanings of finance and business, definition of finance, role and importance of finance in business organizations, sources of finance to business organization, financial institution, capital markets and stock exchange. So these are the objectives, children, that we are going to study in this chapter. So, when we tell the business financial management, so we have to know what do we mean by the word finance. So, when we tell finance, children, is a broad term that describe activities associated with banking leverage. So, what do we mean by leverage? Leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential return of an investment. So, it is the activities which are associated with banking, leverage, or debit, credit, capital markets, money, and investments. Children, basically, finance, when we tell, it represents money management and the process of acquiring the needed funds. Finance is also encompasses the oversight, creation, and study of money, banking, credit, investments, assets, and liabilities that make up financial systems. So, the management of large amount of money, especially by the government or large companies. So this we call it as a finance. Now let us its origin. So in the late Middle English, from Old French, from finer, make an end, settle a debit. From fine, fine, the original sense was payment of a debit, compensation or ransom. Later, taxation revenue, current census date from current census date from the 18th century and reflect since development in French. So the key word finances origin is the due to the overtime, whereas the current meaning is about management. Now, what is financing when we tell? So, what we should know, what do we mean by the word financing? Financing is the process of providing funds for the business activities, making purchases or investing. Financial institutions such as banks are in the business of providing capital to business, consumers, and investors to help them to achieve their goal. The use of financing is vital in an economic system as it allows the company to purchase the products out of their immediate reach. So, according to Gutman and Joglas, the they define the business finance as where business finance can be broadly defined as the activity concerned with the planning, raising, controlling, and administrating the funds used in business. So, we are having one more definition. According to Joseph and Massey, financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. Financial management is the application of the general management principles in the area of financial decision making, namely in the areas of investment of funds, financing various activities, and disposal of profits. So, children, from the above meaning, which is being given by the Gutenman and the Douglas, it's clear that the business finance is the process of rising, providing, and managing the funds in the business. Now let us move on to what is the role of the and importance of the business organization. Larger business have functional areas with specific roles, children. The finance function manages a business, finances and helps with the decision making. This allows the business to manage in the modern world. So now when we tell what we also have to know what is the purpose of the finance function. We are having the two main purpose of the finance function to provide the financial information that other business functions require to operate effectively and efficiently. Secondly, to support the business planning and decision making. Smaller business do not usually have the resources to support a separate finance function. However, larger business can afford to employ the specialists to oversee how the business spends its money and controls its finances. The environment in which business operates can change quickly. The finance function monitors changes happening internally within the business and externally outside the business. It then observes the impact of these changes on the finances of the business. So the importance is the finance is like the life of blood of every business. Without finance, children, there is no business activity is possible. The finance helps us to obtain the resources that are required in the process of production, marketing of goods and services. Finance integrates the various segments of business enterprise for the smooth running of the business in the direction of attaining the organizational goals. It guides and regulates the investment decisions and the expenditure. It helps us for the modernization, diversification, expansion, and the development of the enterprise. It is essential to undertake the research, market survey, advertisement, and publicity for effective marketing of the products. Finance is required to develop industries in the backward areas. Financial stability will enhance the credit worthiness of the concern. So we see that the advent of the corporate enterprises has resulted into two. The first one is the increase in the size and the influence of business enterprise. Secondly, the wide distribution of corporate ownership. And thirdly, the separation of ownership and the management. Now let us move on to the sources of finance to the business organizations. The business organizations, children, it is of two types of finances on the basis of the term of the repayment. They are we are having a short-term finance and a long-term finance. Now let us move on to the what do we mean by short-term finance. Finance that is required for day to day working, we call that as a short term finance. Why this is required, children? Firstly, it is required to meet the working capital needs, that is, to purchase the raw materials, to give the wages and salaries to the laborers, to meet the marketing and the administrative expenses. For that, we need the finance. Secondly, there is always a time gap between a sale and the receipts of sale proceeds. So the gap has to be filled. The financial gap has to be filled between the two processes. So which are those two processes? It is between the sales and the receipt of sale. This one. In between those two, the financial gap should be filled. So the sales and the receipts of sale proceeds, sufficient funds are required. Hence, we need a short-term finance. Then, what sources are there of for short-term finance? We are having many resources, children, through which short-term finance can be required to business concerned. So one is we are having the trade credit, the bank credit, the advance from customers, short-term public deposits, loans from indigenous bankers. When we move on to the trade credit, children, It is the credit that is where a person gets from the gets from the supplier of goods. It is in general practice that the goods are purchased on credit and payment will be made in 2 or 3 installments. So such we call it as a trade credit. Then we are having a bank credit, or we call it as a bank loan. So here the business houses, what they do, they borrow the money from the banks for the 3 months or for a 1 year. So here the bank, what do? They offer a overdraft facilities to the business concerns. Then we are having the advances from customers. In some of the cases, what happens here, the business people, what they will do, they receive the money in advance of supplying the goods. When they have to supply the goods. No, for that, what do? They give the advance to purchase the goods. So that also is also a short term finance. Then we are having the short term public deposit, or we call it as an installment credit. So here what does the do? Here the finance is raised from the public for only for a short term. So some assets are purchased on installment system. Next we are having the loans from indigenous bankers. So when some urgency arises, when there is an emergency, urgent, when we need the finances needed. So that time what happens, the business person will business concerns, they borrow the money for a short term from the indigenous bankers, or they take it from the money lenders. Now we will move on to the long term finance. When we tell long term finance, what do we first we have to know what do we mean by long term finance? Long term finance, children, means the finance which is required for the development of the programs, like the expansion of the level of the production. When there is a demand in the market, when there is a more demand in the market, what happens? The production also should be increased, and the modernization of production methods. So for this type, the finance is required. So, for financing the fixed capital of an undertaking. For example, we have to procure the fixed asset, establishing the new undertaking. And when we tell long term finance, when we say, children, it is costlier than the short term finance, children, here. So, that is the rate of interest will be higher. So, what does it do here? The even the it is the long term finance, when it is given, children, here the securities has to be given. So it is raised by joint stock companies through the issue of shares and debentures, also raised through long term loans from the financial institutions. In that we have the issues of share. So the capital of a joint stock company is divided into a small units that we call it as a share. So here again a one mark question. What do you mean? Give the meanings of shares. So what do we mean by shares? The capital of the joint stock company, what it is there, it is being divided into small units. So these small units we call it as shares. So to start a joint stock company, the promoters, what they will do, they will issue the shares. Whenever they need additional capital for long term purposes, the companies, what do, children? They raise the funds through the issue of shares of the public. Then we are having the debentures. So here the joint stock companies are empowered. They have the empower to borrow the finance for meeting the long term financial requirements through the issue of debentures. So debentures are also the debits, or we call it as a loans, which is borrowed by the companies. So a company which is under its common seal acknowledge a debit to some person containing an undertaking to repay the debit after a specific period. A fixed rate of interest is paid to the debentures holders at a regular intervals. Now we will move on to the financial institutions. There are some financial institutions. See, when I want a loan, when so there are some financial institutions which gives finance for the business. So let us study about the financial institutions, children. There are some financial institutions which are developed to provide a long-term finance to corporate and industrial sectors. So some of them are the important among them are we are having the Industrial Finance Corporation of India, State Finance Corporation, Industrial Development Bank of India, Export and Import Bank, or we call this also as an Exim Bank, scheduled and commercial banks and cooperative banks. Now let us move on to the now let us move on to the Industrial Finance Corporation of India. So this Finance Corporation of India, or in short form we call it as IFCI, this was started in 1948 under the Act of Parliament to give long-term financial assistance to the industries. So the corporation here, it grants the loans to the public, limited companies and the cooperative societies. Here, the state-owned public limited companies can also borrow the funds from the corporation. Next, we are having the State Finance Corporation. We call it as the SFCs. Here, the State Finance Corporation was passed by the Parliament in 1951 to see that to enable the state government to establish the state finance corporations. The act here applies to all the states except to Jammu and Kashmir. The main objective of this State Finance Corporation is to provide long-term finance to the medium and small scale industries in their states. Next, we are having the Industrial Development Bank of India, children. This was established in 1964 under the Industrial Development Bank Act in 1964, and this was owned by the subsidiary bank of RBI till 1976. So in 1976, the ownership was transferred to the central government. Now, this functioning is an autonomous body, and it renders direct financial assistance to long term to the companies indirectly by purchasing the shares and debentures of the IFCI and SFC. It also grants loans to the Industrial Finance Corporation of India and the SFCs. Next, we are having the Exim Bank. Exim Bank is nothing but it is the Export and Import Bank. So this was started in 1982. So it is this bank is owned by the government. It gives financial assistance to the exporters and to the importers. It supports for the establishment of institutions for providing finance to the exporters and to the importers. It also coordinates the working of various institutions which are engaged in financial export and import trade in India. We see that the business concerns raise long-term finance from commercial banks and credit cooperative banks. They can also raise finance through long-term public deposit, venture capital and mutual funds. So children, in the next class, I'll stop here. In the next class, we will study about the long-term public deposits and the venture capital, mutual funds, capital markets. Again, capital markets, we are having two types. One is the money market and capital market, and next we are having the last part, that is the stock exchange. Let us study these in the next class. Thank you, children.